Is Europe falling behind? This is a question that is increasingly common in media among experts and even among many politicians. But what is the answer? Is it true that Europe is falling behind? What are the greatest risks facing the old continent? And since we are on a finance channel, how does all of this affect the markets? Hello to all the community of Finance for All, welcome to another video. Let's dive in after the pandemic and the impact of the Ukraine war. The gap between the United States and Europe has widened. As a result, the economic powerhouse of North America now has a GDP nearly 9% higher than pre-pandemic levels, while Europe has only seen an increase of just 3.4%. We're talking about a difference of more than 5 percentage points in a short period of time. The United States is leading in digital development, making significant gains in energy, and the government is spearheading massive industrial and infrastructure development plans. In contrast, Europe faces a very different situation. For instance, struggles in adapting to technological change have led the Eurozone to lose 20% in productivity compared to the United States since the mid-1990s. Here on this side of the Atlantic, companies find it much more difficult to adopt cutting-edge systems like cloud computing and software applications, largely because European businesses, in general, are much smaller. Regulation, taxes, limited access to capital, and market fragmentation are among the factors contributing to smaller businesses across the continent. It's well known that smaller companies are less productive and invest less. A clear example is the staggering expenditure of just 7 tech giants, Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla, which amounted to $200 billion in 2023. This equaled 50% of all public and private research and development spending in the entire European Union. This stark contrast has widened the innovation gap dramatically, as illustrated by the alarming graph. Another example, in 2023, venture capital investment in the United States tripled that in Europe, and that's not all. To make matters worse, our demographic pyramid is aging more rapidly. What can I tell you? Currently, in the European Union, there are 3 people of working age for every person over 65. This is a statistic that the United States will not reach at worst until 2050. By then, Europe will be in a much worse position, with fewer than 2 people of working age for every person over 65. I think this graph makes it clear. There's clearly a problem, something that French President Emmanuel Macron has emphasized. He says that Europe faces a mortal threat and calls for a significant boost in investment and reforms in the European Union. Perhaps the best indicator reflecting this situation is per capita income. As you can see, Europe has fallen far behind the economic powerhouse of North America. The old continent continues to lose ground. Interestingly, one of the great advantages of American families is that they invest much more in equities, allowing them to achieve much higher returns on their savings compared to European families. In France, for instance, financial savings of families are dominated by savings accounts, deposits, and fixed income products, logically resulting in much smaller returns on their accumulated wealth. Of course, all of this translates directly into the markets. Since late 2019, the S&P 500 has appreciated by over 60%, whereas during the same period, the Euro Stoxx 600 has only increased by about 24%. We're talking about a difference of nearly 40 percentage points in just 5 years. This makes the European stock market seemingly cheaper, but we've also seen how the evolution of the 2 economies is very different. However, perhaps Europe's biggest challenge is not its competition with the United States, but with another giant. Pay attention. We know that this topic is highly recurrent in the media. China's competition in the industrial sector is tough. However, it's reasonably well known that this has been happening for quite some time, at least since the Asian giant joined the World Trade Organization. So, what exactly has changed? Why do we say that this is now one of the major challenges Europe will face in the coming years? Basically, we can highlight 3 major reasons explaining why we will have to deal with a very different context in the coming years. First, as we recently discussed here on If I Had Known, the Chinese government is trying to manage the burst of the real estate bubble by flooding the global market with cheap products. This means that both public and private industrial enterprises in China are ramping up production massively. Beijing's idea is that with this strategy, the industrial sector can absorb the surplus labor currently in the real estate sector, and at the same time, it hopes to stimulate increasingly anemic economic growth. Beyond whether this plan is sustainable in the long term, because supply is growing faster than demand and many companies are operating at a loss, it is a matter of significant international concern. The US government, for instance, has been very clear. When the global market is flooded with artificially cheap Chinese products, the viability of American and other foreign companies is questioned. Not only has the US been clear, but it has also taken action, dramatically increasing tariffs on Chinese electric vehicles and semiconductor imports. This action is designed to protect American jobs. Of course, China's plan is posing much more competition for the European industry. For instance, Chinese electric cars, which are significantly cheaper, are a good example. So obviously, this is the first major challenge facing the European economy, ensuring that this flood of cheap products does not trigger a new wave of factory closures. For now, what we know is that Chinese exports are soaring, and the Asian giant closed 2023 with a trade surplus of over $800 billion. But that's not all. Secondly, China is no longer the backward and rudimentary economy we were accustomed to in recent years. Its government-supported companies are making significant efforts to enhance their technological capabilities, and today, they are ahead in many sectors. Moreover, the Chinese government is developing a plan to reduce its dependence on European and American technology, both to increase production, as we saw earlier, and to make that technological leap forward. The Chinese government is not sparing expenses in this endeavor. For example, in 2022, they allocated over $30 billion in subsidies directly supporting domestic companies. In fact, 99% of the companies listed on Chinese stock exchanges receive government subsidies to aid their operations. In addition to these operational subsidies, there are also subsidies for energy costs, a sector where the government spends nearly 1.5% of the national GDP, amounting to around $300 billion in 2023, to mitigate energy bills for families and especially for businesses. But this is just the beginning. Most of China's industrial policy is implemented through predominantly state-owned banks. The government is mandating these banks to provide loans to industrial enterprises under very favorable conditions, extended repayment periods, interest rates below market rates, and ease of renewal. From a macroeconomic standpoint, these measures could have serious economic impacts in the long term. Subsidies and advantageous loans, for instance, may hinder necessary production adjustments and could potentially lead to a banking crisis. However, in the short term, these measures provide Chinese companies with significant advantages to produce more cheaply and invest in R&D. In other words, the Chinese government is bolstering its industrial enterprises, directly competing with European producers. This is the second major challenge facing the old continent, dealing with Chinese companies bolstered by government support. And don't think that Brussels is unaware of this problem. In fact, the European Union has already initiated several anti-dumping investigations and may join the tariff measures already implemented by the United States. Let's continue. The third major issue Europe is facing is a significant shift in consumer habits among Chinese consumers, a shift that is quite concerning. Chinese consumers are increasingly demanding products from local brands, even over products from major multinational corporations that have previously thrived in China. We're seeing this trend across almost every sector, from Apple iPhones to Volkswagen cars. Volkswagen, traditionally the best-selling car brand in China for years, was overtaken by BYD in 2023, and the situation isn't improving. Meanwhile, industrial production in the European Union is declining at an annual rate of 5%. If Europe fails to address the new pressures from China, the old continent could see many of its major economic pillars collapse. This partly explains why the European stock market trades well below its American counterpart. Simply put, the fundamentals are weaker. However, if the ship can be righted, this can change, and there are many companies trading at reasonable discounts due to this general fear. Having said that, the question is, what would you do to awaken Europe from its slumber? How can we get the old continent back on track? So we come to the end of this video. If you enjoyed it, please like and comment the video and don't forget to subscribe.